Good morning and welcome to the One Heritage Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Jason Upton, CEO. Good morning to you, sir.
Good morning, and thank you for attending our annual results presentation today for the year to 30th of June 2023. I'm Jason Upton, CEO of One Heritage Group, and I'm joined by Anthony Unsworth, our CFO, and Jeff Willis, our Investment Director, to run through today's presentation. So to start, a reminder of who we are. We are a residential property development and management company. We focus on developing high-quality property across the north of England. Our business has two core elements. Firstly, property development, where we develop our own residential property for sale and development management services for investors. And secondly, property services, which primarily includes property management and various services, including design, construction, and project management. Strategically, we had four objectives in place for the period under review. The delivery of our development projects, which 4 completed during the period, 3 direct developments and 1 development management project. We're also expecting a further 2 completions, 1 of our own developments and 1 development management project before the end of this year. And these completions marked a significant milestone for the group and brings an end to the original batch of properties purchased pre-January 2022. As we also made the decision recently that Seaton House in Stockport and Churchgate in Leicester are sold and not developed out by the group following a reassessment of profitability. And overall, pleased to be reporting positive progress against this objective. Our sales have performed relatively well in what is currently a difficult market, which demonstrates continued demand for our property, but I'll update more on this later. The revenue generated from the group services has increased with more properties under management and more recently added to our development management revenue with construction starting on a 129 unit development in central Manchester, which brings an increase in fees during this stage of the project. And finally, with developments completing recently, we are working on securing the right opportunities to replace these. We are still operating in a very challenging market, and Jeff will elaborate on the steps we're taking to adjust our strategy to deliver value later on. So to recap our strategy, we have 2 core elements. Firstly, we are a developer. We acquire land or buildings for residential development within the group. We primarily develop residential accommodation, either new build project or the conversion of existing buildings, such as former offices or other commercial premises. And our geographical focus is the north of England, primarily city or town centres with high demand from working professionals with good transport links. And these areas tend to have similar characteristics in terms of values and expected economic growth. Our developments are either as principal, which are our own developments and development management for schemes owned by a third party, where we had 4 projects under a development management agreement during the financial year. 1 of these completed in January this year, and the second is expected to complete before the end of the year. And these development management agreements generate regular monthly income for the group and a profit share upon completion. The second element of the business is our property services, which includes co-living, construction and property management, which has grown over the period. And we now have over 300 tenants in properties under our management. And what we also believe gives us a competitive advantage against other developers is our wider network in Hong Kong and Asia, which we've demonstrated by securing strong sales. And this network's mainly through our majority shareholder, One Heritage Property Development, who are based in Hong Kong and provide the UK group with a key sales and marketing function. For our own developments, we're delighted to see 3 projects complete during the period, and St Peter's Gate is expected to complete before the end of the year. We also recently made the decision to sell both Churchgate in Leicester and Seaton House in Stockport following a review of viability of these projects. With inflationary pressures on construction costs, the design and sizes of both projects meant it just isn't viable to invest the time and cost to build these out, therefore leading to the decision to sell and use the equity to invest into projects that will deliver better value and reduced risk. And whilst we're pleased to reach completion of our projects, they haven't been without their challenges, which has mostly been a result of difficult market conditions and a contractor insolvency as dominant factors. But the market's changed and we're adapting as a result, which Jeff will elaborate on shortly, but will mean the type of acquisitions we make in the future and our delivery strategy will learn from the lessons over previous projects and have a different risk profile with a greater emphasis on fixing costs where we can and going into the right partnerships with contractors and funders, for instance. But we are entering a new phase for the business for our developments away from self-delivery with a stronger platform due to successfully completing projects now, a more experienced team and defined strategy, which we'll come on to later. We had 4 development management projects, which became 3 at the start of the year following the completion of the County House in Oldham. North Church House is under construction, which is due to complete shortly as we await the structural warranty certificate. We were also delighted to sign the build contract at One Victoria earlier this year, which has seen excellent progress for the construction of 129 units in central Manchester. One Heritage Tower, it's been a challenging project. We have had success achieving planning permission, which includes revised planning permission last year, have progressed the design and reduced costs, but we are exploring options to either deliver the project or sell it at present. But I am expecting to be able to report further progress on this project over the coming months. And overall revenue from development management has been valuable to the group as we benefit from consistent revenue without risking capital. Our newest development management project, for example, One Victoria, should generate over £18,000 per month in fees until mid-2025, which will equate to around 2% of the development cost, in addition to a 1% fee generated, a finance secured, and a profit share upon completion set at 15%. We are also exploring options to take on more development management projects in the future, which we have taken steps to do by restructuring the team and discussing potential opportunities with local authorities and other third parties, which has happened now. We've got completed developments, including completed development management projects, and have added expertise and experience to the team who have the right experience to enable this area of the business to grow. And as reported previously, we have had mixed success with our sales. We recognised on some of our projects that units were maybe sold too soon, which is positive to have secured sales early and reduces sales risk during construction. But it can be problematic in the event of project delays and gives us no flexibility when prices increase. Of course, with the benefit of hindsight and the majority of our sales have completed, the main impact we have had is with a couple of bulk buyers that didn't perform. One last year at Lincoln House and one Farsker House recently for all 27 units. And whilst this has delayed sales, we have benefited from price increases with the value of Lincoln House and Oscar House now higher as a result. And new sales such as the bulk sale of 20 units at Lincoln House in October has been of high value, for instance. But the market is very difficult at present, which is the case globally for overseas investment in residential property. There are significant macro challenges along with high interest rates, which has dampened the market. And whilst there is demand still, we are conscious the rate of sales may be slower than in previous years and expect the market to pick up at some point next year, with experts predicting this could be anything from from Q1 through to Q4. But our sales today has given us sufficient equity to invest into our next projects, which we expect to be active next year. And where property isn't sold, we are generating revenue by renting out the units. Our Victoria Road development, which is 24 new build houses, will be marketed for sale next year. And this is a different product to our other developments and won't be sold overseas. We will be offering this to the local market to owner-occupiers. But overall, pleased to have secured sales in a highly competitive market with our brand and reputation growing. I'm now going to pass you over to Jeff, Investment Director.
Hello, everybody. I think as Jason points out, there were quite publicised headwinds that as a business we are very aware of and we're well placed, I believe, to manage. We've also concluded, with concluding the first wave of practical completions, our strategies to bring new ones into the business. We're well structured now. We've got a very capable team looking at sites across the north. And we've, as I'll talk about later, we have a series of core metrics that we now follow, which will enable us to have a lot more control over where we go from a commercial perspective. We're obviously aware of market risks and we're managing them. These risks are not exclusively ours. They're industry risks, which affect everybody, of course. And for us, it's about how we manage and react to the risks. And that's very much part of our strategy going forward, and identifying opportunities where we feel we can add value in such a way that the risk can be mitigated. Nevertheless, the fundamentals of the market are very strong. Market is very resilient historically for housing. There's obvious demand. Population is what it is. And as Halifax are pointing out in the recent survey, values are starting to become a little bit more normalised at the moment, and hopefully from that base, positivity will rise into the new year. Our objective is to target our investment in the most effective and efficient ways possible in order to maximise commercial benefit in terms of programme, capital and revenue terms. Supply obviously remains constrained, and we see various barriers to the market we need to manage, as I pointed out, as I suggested before. Build costs are an obvious issue, where construction labour materials have increased at around 25% since pre-pandemic levels. A big part of the problem for UK house building has been the reliance on imported products, notably from the EU, where traditionally 60% were sourced. And the cost of programme implications have led to cost control issues, which are very much highlighted within the Chief Executive statement. Over the same period, sales prices have risen circa 15%. So you can see where the viability gap, one of the reasons why a viability gap is starting to emerge with developments. Finance costs are also something that are starting to impact on development. At the end of 2021, base rates were 0.1%, now 5.25%. So there will be an implication in terms of how we manage projects, in terms of holding lengths, etc. And with its overall opinion on viability having to show somewhere within the overall development appraisal. Increased borrowing costs will affect the market by making holding costs higher, and consequently, it's possible that more sites will come to the market in the coming months when we can potentially benefit from, particularly with option periods expiring. Construction capacity is another issue. Around 1 million of the UK's 2.5 million construction workers are employed in house building. The workforce is quite close to capacity, and the building target of 300,000 homes per annum is very difficult to exceed. So we need to be aware when we place contracts for construction that we go to well-resourced contractors, and also be aware of the wider dynamics with the industry. The overall key point, as pointed out in the slide, land availability is an obvious thing. In city centre locations, population's increasing, competition for sites is high, and land is constrained, of course, very much in supply. We need to prepare for future challenges and have built this into our acquisition strategy. Building regulation changes are also quite a significant bearing on our market at the moment. There's been 9 changes between 2020 and 2023. All have led to cost and programme considerations. We're also minded of regulatory change, Building Safety Act in particular. And as a business, any scheme we're looking at obviously has this as our foremost. Political support and direction is also a very important point for driving development. We see clear public sector support and decision making as fundamental. And as we approach an election year, I think we also need to be minded in due course about the likely implications on development delivery. Overall timing of investment will be important, and we are placing careful attention to the market and considering multiple the variables discussed. In terms of our brand development, it's been a big thing for the business in the last few months, working hard at establishing 2 very core brands within the business, or and trying to set some form of brand definition to them. We have One Heritage City Centre Living and One Heritage Homes. Our primary focus remains city centre living, and we're seeking to supply this market as a priority on the basis we find the right projects with the right metrics. In city centre locations, notably Greater Manchester, Leeds, Sheffield, Liverpool, York and Chester, where we see viability of being quite strong. Where there's a viable business case, we're seeking apartment schemes from about 30 to 150 units. In commuter areas, we're looking to develop the Homes brand and provide lower density housing and apartments in areas that particularly benefit from strong transport links, be particularly attractive. Our focus is developing on brand standards and differentiating our product, where in effect we try to where we kind of ultimately want to try and find angles to create comparative advantage and to purchase land and property assets effectively. As part of all of our processes, we're considering modern methods of construction to speed up programme, as long as viability can be proven and is commercially beneficial for us to do so. And we're also very conscious of our ESG agenda. With each project, and as we proceed to do more and more projects, our brand will develop and mature further. Process-wise, we've also in the last few months put in place some additional processes. We have a standardised Argos Performer, and with the new team that we have a reporting process which allows for clear and transparent and not particularly cumbersome decision making, which involves reporting internally to Jason and also to the board at large when we make decisions. I think on balance, this approach will enable us to be able to drive forward projects that will be a lot more commercially profitable going forward. We have looked at past performance of projects, and we've done it at length to see what we're doing well and what we can do better. We've highlighted issues with cost control, again as mentioned, and we've reflected that in the revised procurement strategy. All acquisitions will require a minimum level of due diligence and robust appraisal and financial assessment, which includes early engagement with cost consultants to identify areas of risk. Where risk is identified, it is managed. Our contractor procurement approach is to focus on fixed price contracts, where risks are managed and known before we start on site. Contract certainty enables us to be able to forecast future performance, delivery programme better, and manage risks in the longer term interests of shareholders. We have I think as I've alluded to, a very dynamic and strong team now in terms of acquisition with a varied skill set, which has been reinforced yet further in recent months. Our scheme is a blend of private and public sector experience, and the recent hire from Jones Lang LaSalle has given us increased visibility with key agents. Our visibility to the market is good, and we're seeing a range of opportunities, and we're making sure the team gets out more and is a lot more active and engaging with the market. Historically, we've tended to buy schemes with planning permissions in place, and whilst we have an immediate requirement for deliverable projects, it has left us vulnerable to market forces historically. When the market is strengthening, the strategy can be effective and enables us to get on site quickly. But in a more static market, we probably need to be more innovative, and that's what we're trying to do. We're considering a range of projects with and without planning permission at the moment, plus developments where we can provide an effective development management service, as Jason alludes to. We will look at stalled sites when they're ready to start, or sites with a longer term horizon when we can more easily apply a developing brand and guide specification. Early engagement is always, as a general view, something we quite enjoy. We have a team looking at projects and reviewing a wide range of opportunities currently across the north. We won't discount sites from a geographical perspective further afield, but we obviously need to be minded of where our core competence sit and where our development team lies. At an early stage, we identified likely funding requirements and work with colleagues in finance and specialist advisors, which we have a growing network of, on putting in place the required capital funding stack to consider potential pots of external funding that may be available. We will also work from an early stage at identifying likely end users and commercial exits, which we see as being fundamental to the future success of the business. In all cases, we're looking for projects that meet our core metrics and are located within our target areas. We're looking at a range of projects at the moment. We're looking at income producing assets where there is potential to hold for a period of time to enable us to time the development when is appropriate. This will allow, of course, to plan for future redevelopment. As a team, we've now got skills within it to open up much more than traditional vanilla purchases. We're planning tickets and looking to work and partner with local authorities and to deliver placemaking projects where commercial risk can be balanced over a longer term time frame and grant support introduced where appropriate. And some of these deals over time will take time, but could be very commercially lucrative if we manage it the right way. We're looking at partnerships with third-party investors and developers to acquire larger sites. So we're not discounting ourselves from all market opportunities that exist, and we can take advantage of particular site as and when it becomes available. And with all cases, and it's particularly prevalent in the Manchester market at the moment, we're looking at funding pots, grants, GMCA, brownfield grant funding being one of them, and all ways of just trying to be innovative and different. In reality, I think a combination of that will prove to be quite successful. From the sales side, I think we all recognise the market's turbulent, and it's something important for us to do to mitigate risk. We'll look at forward funding deals, forward commitment deals, as well as the traditional unitised sales model that we have historically done. Deals funded by public sector bodies and housing associations are also probably an ever-increasing part of what we need to consider. We'll possibly even consider looking at holding assets directly as long as there is a business case for that, although I suspect that's probably at this stage a little embryonic. I think our primary focus still ultimately remains the build-to-sell market. If I turn to the following and next slide, finally, I think we've highlighted an example of how we might progress the development of an income-producing asset with development potential. This illustrates the length of the programme we might expect with a development of a similar nature. I'd like to hand over to Anthony to continue the presentation.
Back to me. Thanks, Jeff. So this slide outlines our property services, which has seen further growth and improvement during the period. Our property management now has over 300 tenants under management and has seen various improvements, such as achieving Property Mark accreditation early in the year. Fees we generate depend on what we're managing. For our co-living properties, part of the management is outsourced to local agents, and as a result, we share the management fee and means we receive around 5% of the rent collected. For residential properties, we manage these fully in-house, so collect around 10% of the rent as our fee. Property sourcing has been for investors looking to purchase residential UK property, along with sourcing property for co-living development. Co-living refurbishment revenue is generated at 5% of the cost of projects, which has generated over 60,000 in fees during the period. And these properties, once bought and sold, generate further revenue as we handle the transactions, and the wider work on co-living is from a service agreement of which we generate £100,000 per annum, which goes towards head office and operating costs. Our property services are other consistent sources of revenue, aiding our property sales and allows us to provide vertical integration across all stages of property development, including post-completion. But we are keeping our property services under review to ensure it delivers value and to identify new revenue streams for the company. I'm now going to hand over to Anthony to run through the financial review.
Thank you, Jason. First then to look at the headline numbers on this slide, financial review performance. It's definitely worth me expanding on that first line, the revenue line, which has seen a significant increase on the prior year. It's the highest ever reported by the group. And not only is it the highest ever, it's also the best quality ever reported, with the majority of that income from external parties, which is a seismic move away from a heavy contribution from related parties. So revenue was nearly 15.6 million, roughly a £13.8 million increase on prior year. Approximately 10 million was generated from external parties outside the wider One Heritage Group. So this record revenue has been delivered through a number of sources. By far the largest contributor to revenue was from development sales, and as just mentioned, which was 10 million. So this came from 54 completions at Lincoln House Bolton, delivering 6.7 million, and Bank Street Sheffield legally completing 17 sales, equating to 3.3. And another key contributor to revenue, as Jason mentioned, was development management fee income. This was 0.7 million in the year compared to 0.2 last year, an increase of 0.5 million. This is mainly due to One Victoria, which contributed 0.4 million to this growth, and Oldham, which delivered 59k in a profit share agreement that we had. So the projects within development management, as Jason said, are North Church House Sheffield and One Heritage Tower Salford. Within revenue as well, there's construction services, which delivers revenue through two key streams. The first one is through co-living property development, where the group receives a 5% cost plus margin, and this stream delivered 1.3 million of revenue. And the second area is where we provide in-house services for a related party project at Queen Street, Sheffield, which is a refurbishment project where the group is a development manager, and that delivered 3.2 million. Property services and lettings delivered revenue of 0.3 million in the financial year, and this was driven by management fees and transaction fees. So a relatively robust performance within revenue, delivering them increases. As we move down the P&L, gross profit improved by 1.3 million from a loss position of 0.7 last year to 0.59 million gross profit this year. And that increase has come mainly from the completions from Lincoln House, a profitable development, and the large increase in development management income. Impacting gross profit in the year, we should remember, reported at half year, was the impairment of 3 of our projects. That impairment was 1.1 million at December, and I'm pleased to say there's been a slight reduction in that in the interim results of December, from the interim results of December. So just on impairment, I think it's right for me to say at this stage another reminder that there's been a number of changes implemented in the year to reporting, risk management, operational delivery to better protect the group from similar challenges in the future. Most notably, the cessation of in-house construction services to both our direct development and development management projects in favour of the appointment of a fixed price principal contractor on all new projects. So our newest development, Victoria Road, Eccleshill, which commenced in this period, is with a fixed price principal contractor, and it's in line with this strategy. Down to gross margin percentage, there was a positive 3.8% reported for the year, compared to negative 40% last year. Admin expenses, which sit between gross margin and operating losses, which I'll come on to in more detail in a minute, were 2.2 million in the period versus 1.5 million last year. And then you get down to operating loss, which decreased by 0.5 million. So a reported loss of 1.6 million. Below operating loss sits finance costs for the business, and these were 0.5 million in the period. The increase in finance cost is attributable to Lincoln House, Oscar House, Bank Street developments reaching practical completion in the period, and the finance cost is a cost of holding unsold stock. Unsold stock, as Jason mentioned, continues to be at the centre of management attention. Overall pre-tax loss is in line with last year at 2.1 million, but I'm pleased to say a slight improvement in basic loss per share from 6.6 to 6.2 pence per share. So in summary, performance was robust. We have a clear focus on the core operational areas of development management, property services. Roles and responsibilities across the business are aligned to the sources of revenues and profits. Learnings from the impairment have been incorporated into the group's risk management. And with a growing pipeline of developments and the strengthening of the teams to deliver, the group is, I believe, in a strong position to achieve controlled growth to deliver improved shareholder returns. As I move now to administration expenses, so the granularity here at a higher level than what's in the annual report. Overall, costs have increased by 0.7 million from 1.5 to 2.2, with the increases coming from a number of key factors. The largest one is an increase in salary cost of some £480,000 year on year. This has been driven by an increase in average headcount from 23 to 28 employees year on year, and coupled with more experienced individuals joining the team, including an extra board member, and an increase in the recruitment costs to build that team for the future. Moving on to professional fees, where we've seen an increase of 176,000 year on year. This comes from a number of factors, mainly an extra 61,000 expended on consultancy services, 20,000 increased audit fees, 30,000 on higher software costs, and a legal fee provision for a claim and a potential liability. So 2.2 million expended in the year. We've covered salaries and professional fees, so the others are bracketed as other administrative costs. So there's been an increase of 74k in these other costs, mainly due to increased costs of insurance and PR services. I think before I move on to the balance sheet, I think it's fair to say on overheads, we have seen the increase, and overheads remain a key focus of the management with tight control. And whilst we're introducing some planned investment in costs to drive them revenue streams, admin costs overall as a percentage of revenue were 85% last year, and this year they are 14%. Balance sheets. So turning now to this, looking on the next slide. The cash and cash equivalents I'll cover in detail in a moment on the cash flow slide. So overall position, net assets have decreased by 1.1 million. We've now got negative equity of 0.6 million, which is obviously due to an increase in borrowings, funding future growth and supporting developments with unsold stock, but also recognising the prudent impairment of assets as described earlier. The completion of properties at Lincoln House, Bank Street and Oscar House, Manchester that have taken place in the period have commenced a shift in the balance sheet, which will ultimately allow for funds to be directed into targeted acquisitions as the group moves forward. As anticipated, no dividends have been declared in this year, with losses being reported for the first 3 years of trading. So the two significant values on the balance sheet is inventory and borrowings. Development inventory has increased by 1.4 million from 15.1 to 16.6. The key increase, 2.3 million in Oscar House, which completed in the period but did not deliver any sales completions in the financial year. This is due to some of the issues described by Jason earlier. And we've got two sites completing after June 23, which is St Peter's Gate and Victoria Road, Eccleshill. Notable reductions in inventory have come from Lincoln House and Bank Street, which did recognise sales completions in the period. Borrowings have increased by 1.3 million to 17.2, with the increase in shareholder loan replacing loans repaid and providing increased funding to the group to cover overheads and unsold stock. Overall, net assets per share decreased from 3.3 pence to 1.5 pence. So in summary, the balance sheet structure reflects the strategy of funding development projects with a combination of debt and equity instruments. As the group continues to progress, and with the development projects reaching completion and realising sales, the balance sheet will in due course reflect the positive cash impact of such transactions, allowing funds to be recycled into new projects through targeted acquisitions. If I can look now at the cash flow position. The cash balance for the year to 30th of June 2023 has moved from 0.97 million to 0.3 million, so a reduction of 0.7 million highlighted in that June 23 column. The makeup of that movement, as previously reported, the group's reported an operating loss of 2.1 million. This loss is adjusted for non-cash items of 0.7 million. Lower working capital of overall 0.9 million has provided a favourable flow of cash, and this was mainly due to lower inventory of 0.7 million. With relatively small changes overall in investing and financing activities, the cash outflow from operations of 0.6 million is the key factor behind the overall cash movement. So in summary, the net cash outflow for the period was 0.7 million. Finally, a summing slide. As I say, a relatively robust year, albeit with some issues that have been addressed. Revenue is at 15.6 million, the highest ever recorded, and a significant increase on last year. Operating loss of 2.1 million was after impairment of 1.1 million, and net debt sits at 17 million, with continued support from the parent group. Within the year, there was a subscription with existing and new investors, and that raised 1.3 million. Overall, I believe the business is now in a strong position with a new team focusing on acquisitions, delivery, and sales. There's no doubt that there will be controlled growth now as we look forward and improved shareholder returns. Thank you.
Thank you, Anthony. So as highlighted earlier, there are 4 strategic priorities in place for the period. We've seen good progress finishing our projects this year, and the delivery of our remaining projects, along with development management projects, remain a priority. Our sales and property services growth will be critical to generate revenue over the forthcoming period, and new projects will need to be identified to build our pipeline. And we are fairly positive in terms of the outlook over the forthcoming period. The market challenges and cost pressures that continue to affect the industry will mean we'll be taking a cautious approach, which is why we've been patient with our acquisitions. We have a strong team with a proven track record, and we are seeing opportunities in the market, which I hope will come to fruition over the coming months. And overall, the outlook for the whole residential market is mixed. Interest rates and the cost of living has caused a slowdown in new purchases, but it is important we're focusing on the right areas. City centres remain in high demand due to a lack of supply, and these areas will be a focus for us. And during a difficult sales market, it is important we have options to generate revenue, which is what we're seeing from unsold units across several of our developments, property services revenue, and development management income, which enables us to be resilient. And these additional revenue sources will be areas of focus whilst our pipeline builds over the coming period. And thank you all for listening, and we'll now take some time to answer any questions.
Perfect, Jason, Anthony, Jeff. Thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few minutes to review those questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you know, we received a number of pre-submitted questions. We've received a number of live questions as well. If I could just ask you to read out the questions and give responses where it's appropriate to do so, I'll pick up from you at the end. Jason, over to you.
Oh, sorry. Anthony, you okay reading the first question?
Yes, thanks, Jason. So the first question is a question related to the inclusion of a corporation tax payment in the accounts, and questions about the computation to that. So the question that we've received is very similar to an email question that was received. So I believe that question has been answered.
Okay. So the second question we've had is, given the executive team has not won any third-party development management contracts in 3 years since listing, on what basis can it be stated with any confidence that this is a viable new income stream, not least because the segments targeted are extremely competitive with some big players involved, both local and national, with demonstrable track records and the necessary strong balance sheets and profitable track records. The executive directors leading this marketing push with face-to-face meetings with the CEO leaders of the councils in the Northwest, as well as the equivalence with housing associations, as well as small businesses pitching for new clients. That leadership is crucial. Why family offices, small private equity funds not being approached? Well, firstly, the group has had 4 development management contracts in place during the last financial year, and we only finished our first development projects earlier this year. And the timing of how we leverage our services is crucial, which we haven't been able to do until the company has completed projects, which is what we now have. And we've got the right team in place, which is what we now have, with Jeff being a notable addition earlier in July of this year, with significant public sector experience. Therefore, we've only recently been in the position to explore third-party development management contracts away from the wider group, effectively over the last few months, as we updated in the results recently. But we will be providing an update, or we hope to provide an update on further progress over the coming months once progress has been made in this area.
So question number 3, to what extent, if any, are the expected sales prices of unsold units above the current book value? So simply put, selling prices are set at today's achieved prices and are exactly the same as the book value. Question 4, it would appear that the current level of income generation does not cover the run rate of costs. Comments, please. So, yeah, we've been cautious in our acquisitions approach. There's now a new professional team in place, focusing on acquisitions, delivery and sales completions with minimal risk through fixed price contracts. So acquisitions are expected in the new year, as hopefully you've just heard through the presentations. Question 5, is quite a detailed question from the notes in the annual report around segment analysis. So if I can take these, try and take these in bite-sized pieces. The first one is, how can construction have no allocated administration expenses? Well, that's because there are no direct employees. The only admin expense is bank charges, which is immaterial. So due to the nature of the entity, the majority of expenses is cost of sales. The next segment of this question is, how can genuine corporate administration expenses truly total 1.16 million? And the answer is, it's because that is group-related costs. So half of this balance, just under 0.6 million, relates to salaries for personnel in the corporate segment. And included in this as well are group-related professional fees, that total 400k. And the rest of the costs relate to office rent, heating, insurance and general expenses, listing and investor communications. So they are group-related costs, which is why they are in the group segment. Next one is, why is the finance cost 65k when the cost in the first half was 158k? 65k is the right of use asset, and Lincoln House interest was included in this segment in the half year. This is now shown in the development segment as finance costs, but it's just a classification change. Next one is, why is 108k of income from Robin Hood Limited shown as corporate income when it relates to a segment activity? The answer is, it doesn't relate to a segment activity. It's management fee, and it's not co-living activity, and it's reported in the notes to the accounts. There are a couple of further questions about property services. Is it profitable? Has it got a viable future? And wanting an understanding of how this area has changed from half year to full year, which I believe them questions have been addressed as we've gone through the presentation.
Okay, I've got a question here. Are the units at Oscar House on Airbnb, not now Booking.com, and a student site owned by the company or third party? So the units at Oscar House are permitted to be used as service accommodation. Unsure which units may have been seen on Airbnb, and I'm not aware of a student site or how these are understood to be Oscar House, but we are exploring service accommodation as use on units where we can for our unsold stock, as we updated on in the results.
Next question is other administration expenses as they were listed in the annual report, which have increased from 382 to 696, and at half year they were 507. And the question is, at the half year there must have been chunky one-off or annual costs, in inverted commas, in the period to December. What costs drive the total? So administrative costs, I think I covered in my presentation. Hopefully that's covered off. In terms of the change from half year to full year and the other administration costs, the half year included bonus accrual, and this was removed at year end due to the losses reported. So hopefully that answers that question. Final question is a question on what's the outlook for house prices. I think if I can answer this in two parts, one for the general market and one specifically for One Heritage. I think, as Jeff alluded to earlier, there's been a recent publication by the Halifax, and they're reporting a price increase of 1% in October, but a 3.2% fall over the year. Key factors driving this this increase in the month is a low supply of homes for sale in the market, so that has strengthened prices a little, but I think it's still fair to say that the market remains weak. So many people will have had pay increases, but higher interest rates and affordability issues will continue to challenge. I think as we look forward, and much is going to depend on what happens to inflation, and much will depend on how the Bank of England reacts to that with interest rate changes. But the Halifax suggests price falls in 2024 before growth returns in 2025. So that's the first part. Then the second part, focusing on One Heritage in terms of prices. We believe that we focus on areas which are more resilient to negative pressures in the market. So, city centre with poor supply of product but very high demand. So we believe if the market becomes really difficult, there's opportunities to tenant unsold properties and provide a revenue stream. This as opposed to dropping and cutting selling prices and significantly impacting margins.
Okay, I've got a question here. You've made losses on you've made losses on a few of your projects. What are you doing now differently to ensure this doesn't happen again? So this topic's been covered over the last few results, but to summarise, the core reason for increased costs and losses are due to a contractor insolvency, which led to the decision to bring in-house construction services to self-deliver back in 2021, which meant we were vulnerable to inflation and subsequent cost increases, which we wouldn't have been affected by with a fixed price contract with a principal contractor, and something we're not going to do again in the future. Our acquisition strategy and development teams also changed over the last 12 months in particular, with Jeff coming on board to lead our acquisitions in summer, and a restructure of our development team with experienced professionals appointed, which ensures our processes and delivery strategy continues to improve. But where we are today is that nearly all of our what we would describe as legacy projects, so those purchased pre-January 2021 are all but completed. A new development team is effectively in place, and we're working hard in a difficult market to ensure that the projects we do commit to are future-proofed and deliver strong returns, which we will benefit from in the years to come.
There's a question on, do we have any plans to raise equity given the negative equity position? Yeah, so there's no current plans to raise equity, but obviously it is an option as we're a PLC. I think for now we've got strong support from our majority shareholder as we move to the new phase and start delivering profitable developments, which will obviously improve that negative equity position.
I've got another question here. What's your biggest concern for 2024? I mean, I'd say my concern is any worsening of the market. We didn't anticipate another war or the level of inflation over the last 12 to 18 months that we've experienced. But there are signs of improvement that give us positivity that the worst is now in the past. And as I mentioned earlier, we are being cautious and conducting some contingency planning, which makes the company more resilient to these macro factors. But the future performance of the business will be dependent on our acquisitions and investments, which we choose to make over the forthcoming period, which is essential. We do choose wisely.
A couple of questions that have come in from Keith, one on the legal provision that I mentioned on the admin slide, and one on the Oscar House figure that I mentioned on the balance sheet slide. First question on the legal fee provision, what does this relate to? Well, I hopefully we can understand that I'm limited in what I can say on this because it's a legal matter, but we do have a dispute with a contractor at one of our self-delivered sites, which we are seeing through and hopeful that the provision can be released. The second question is around Oscar House. How is Oscar House inventory only 2.1 million and the site is worth 6.8 million and there's only been 7 sales? I think to this one, I think the 2.1 million I mentioned was a year-on-year increase, and the actual inventory on Oscar House is 6.3 million, detailed in the annual report.
Jeff, are you okay answering the question on economic impact of investments?
Yeah, I think when we look at development, we look at all different variables that might affect it, I think particularly when you develop it with certain areas, you need to think about affordable housing provision. You need to think about how you can marry your offer to meet market needs. We need to think about working with the local authority as well, which is a very important thing in terms of often requirements such as local labour provision and provisions along those lines. And we're also looking at projects at the moment. Looking at one project at the moment that has potential to make a big difference from a social economic impact perspective. So in terms of everything we do, we want to be minded of leaving the right legacy, and as part of our core brand value that we referred to earlier, we want to keep building up that, and hopefully with time, expand more into actually having a clear defined strategy from that perspective.
Yeah, a question which I'll pick up. Can you please answer the tax question for the broader investors? So on the face of the P&L, there's provision for a tax liability. So without getting too technical, the PLC accounts include numerous entities that are consolidated. A number of these entities made a profit. The total taxes payable on these profits amounted to a tax charge of 250k. Now, there are sufficient losses to fully offset the profits on which we have recognised the liability, and we're therefore electing to utilise the group relief in the coming year to offset this tax charge, and therefore we do not expect to physically pay these funds to HMRC.
I've got a question. How likely is it that acquisitions and/or JV deals are likely to be announced before the interim results announcement? So I mean, there's a number of opportunities we are assessing and doing our due diligence on currently. We wouldn't want to release any form of kind of forecast in terms of acquisitions or JV deals. Our acquisitions are going to be selected extremely carefully. We've now got a strong acquisitions team in place that are looking at multiple options and opportunities within the market. JV deals in particular and development management opportunities tend to take longer by virtue of working with public sector bodies and third-party investors. So they may take a bit of time. But we're fairly hopeful we should have some positive news over the coming months.
Question on is the group experiencing any issues with sourcing opportunities and lining up contractors? Obviously, with the background that the business is loss making. I'm pleased to say there's been no there's been no issues experienced over the last 12 months. We've took out new construction finance, we've entered into contracts, a significant build contract, and I think our partners, as we move the business forward, can see the credibility of the current management team and the continued support from our major shareholder.
Perfect. Jason, Anthony, Jeff, thank you very much for that. I think we actually addressed all those questions from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which is particularly important to the company, Jason, could I just ask you for a few closing comments?
Sure. So thank you for attending our annual results presentation this morning. It continues to be a challenging time with significant market factors affecting progress. But we are in a stronger position following the successful completion of developments this year and the strengthening of our team. I hope the update provided, specifically from Jeff, provides further context to the work we're doing in the background and where we believe opportunities exist. and we remain confident and optimistic about the future. And as we make further progress, we will be providing updates, which I hope to be doing over the coming months. Thank you again, and enjoy the rest of your day.
Perfect. Thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, so I'm sure will be greatly valued by the company. On behalf of the management team of One Heritage Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.